Greetings. Getchell Gold Corp is pleased to present the results of the 2025 Preliminary Economic Assessment that highlights a robust and potentially very profitable operation of the Fondo Canyon Gold Project in Nevada and represents a major milestone for both the project and the company. The Preliminary Economic Assessment outlines an open-pit mining and conventional 8,000-ton per day milling operation with an initial planned mine life of approximately 10.5 years and the sale of a high-grade concentrate to a local third-party refinery. A highly commercial endeavor at a base case gold price of $2,250 per ounce and 84% gold recoveries is envisioned, with the scoping study reporting an impressive $546 million pre-tax net present value at a conservative 10% discount rate, an excellent 51.2% pre-tax internal rate of return, and a short payback period of 3.1 years. Taking into account taxes, the project retains a high value with $474 million after-tax net present value and a 46.7% internal rate of return. Supporting the value is a healthy production schedule that is projected to generate 1.23 million ounces of gold over the operation's mine life, with a notable average annual gold production of 117,300 ounces of gold. The company is elated as to the potential valuation of the mining operation reported in the PEA, as well as the incredible upside for Getchell Gold Corp and its shareholders to be realized. Following is the detailed summation of the preliminary economic analysis that highlights the potential for a robust economic open-pit mining operation at Fondo Canyon. The Fondo Canyon Gold Project's claim group is 7 kilometers long by 3 kilometers wide and fully encompasses the east-west gold corridor, host to the mineralization identified to date. The PEA solely focused on the open pitable resources in the central area, outlined in red, that represents only a portion of the largely underexplored gold corridor. The open pit optimization model, using a 0.5 gram per ton gold cutoff grade and an average life of mine stripping ratio of 4.7 to 1, yielded a pit shell containing 11.7 million tons of indicated mineral resource at a grade of 1.73 grams per ton gold and 18.7 million tons of inferred mineral resource at 1.3 grams per ton gold for 655 and 818,000 contained gold ounces, respectively. The preliminary economic assessment contemplates an open-pit operation using contract mining and processing 2.9 million tons per annum, or 8,000 tons per day, yielding a 10-year mine life. The economic parameters underpinning the economic model is an average mill feed grade at 1.5 grams per ton gold, 84% recoveries, at a base case $2,250 per gold ounce. The project displays an excellent cost profile, with total capital expenditures, including a 20% contingency, estimated at a manageable $226.5 million and operating costs reporting well below the spot price of gold. The potential operations base case, utilizing a discount rate of 10%, yields strong pre-tax and after-tax economics. Given the conservative nature of the base case economic parameters, discount rate, and gold price, the project exhibits resilience to the downside and considerable accretion in value on the upside, as evidenced by the sensitivity matrices presented here. The mine plan and production schedule provide a very short ramp-up, achieving peak production targets by the end of year 1 and maintaining consistent high production through the life of the mine. This reflects the at-surface occurrence, consistency, and amenable geometry of the underlying resource. A conceptual siltation plant was designed, with the facility processing oxide and sulfide mineralization at an average gold recovery to concentrate of 84% estimated across the material types. A processing throughput of 8,000 tons per day was selected, aimed at maximizing gold recovery in conjunction with minimizing concentrate mass pull, capital expenditures, and operating costs. The process flowsheet will consist of 3 stages of crushing, followed by ball mill grinding, rougher flotation, and 2 stages of cleaner flotation to produce a high-value concentrate. There are a multitude of avenues to improve the project's economics beyond its already favorable measure. The first and foremost is the price of gold. Naturally, due to the project's high sensitivity to the price of gold, any appreciation in the gold price above the PEA's base case gold price has a steep positive impact directly applied to the economic model's bottom line. Considering the spread in the PEA's base case to the current price of gold, and assuming the continuance of a robust gold market, a higher valuation may be anticipated. A second avenue to pursue is to add more gold to the economic model. The project is fortunate in this regard and possesses exceptional gold resource growth potential. Looking down, the plan view shows the drill hole traces with gold grades and the 2024 mineral resource open pit shells along a 2.5 kilometer length of the east-west gold corridor. Zooming in to highlight the main pit in the project's central area, the drill traces become more discernible. Taking a 450-meter slice and isolating the limits of the drilling, the gold intervals on the periphery at the furthest strike extent of drilling are strong and pronounced. This indicates there is a significant potential to increase the mineral resource along strike in both directions, external to the current resource as well as internal to the mineable shape modeled in the PEA. Rotating and tilting a 3D slice, showing a series of drill holes in section, the broad and consistent zone of gold mineralization becomes readily apparent. Layering in the mineral resource gold grade block model, a better visualization of the volume, thickness, and favorable shallow dipping geometry of the gold mineralization is provided. The model clearly reveals that the down dip extent is wide open for expansion, as is the potential to extend the mineralization up dip towards the surface. In conjunction with adding more gold to the project's economics, it must be noted that the economic model only considered the portion of the resource that was captured within the main open pit shell. The outstanding balance may be directly additive when rolled into the mine plan of a future economic analysis. As well, potential discoveries resulting from future drilling along the 7-kilometer-long, underexplored east-west gold corridor can be distinctly additive. In summary, the upside potential at Fondway Canyon is striking. All the target areas along the gold corridor are open for expansion. This fits in nicely with the company's goals for 2025. A Phase 1, 4,000-meter drill program has been designed to target the priority areas, internal and external to the open pit mine model. The intent of the drill program is to significantly expand and increase the resource, as well as provide guidance to the company where to focus a Phase 2 drill plan for additional, maximum positive economic impact. Alongside resource growth, efforts will continue in 2025 to refine and optimize gold recoveries and upgrade the concentrate. The preliminary economic assessment has outlined a favorable process and concentrate product, with the metallurgical test work indicating complementary processes to evaluate that when integrated is expected to deliver superior recoveries. The Fondway Canyon Gold Project is off to a stellar start and is in an enviable position where it has yet to approach its limits and possesses great capacity to realize a considerable increase in value in excess of its currently defined strong economic outlook. This year should be an exciting year, especially given the record price of gold and the potential value add that the company's endeavors will produce. Thanks from Getchell Gold Corp, trading on the CSE under the symbol GTCH, GGLDF on the OTCQB, and GGA1 on the Frankfurt Exchange.